If you've been listening to the HopeFilled Financial Podcast for a while, you know that I like investigating retirement distribution strategies. I believe that it is important to begin our plan with the end in mind, and that we should have confidence and understanding about the relative risks that different retirement distribution strategies introduce to us. If we go with a flat rate or a bucket strategy, as I talked about last week, or a retirement guardrail strategy, I want you to know, is this going to be a good way for me to protect my retirement goals? And everybody is going to have a plan that best fits their needs, best fits their goals. What works for you may not work well for your neighbor. There is no one size fits all strategy that is the end all be all for retirement planning. However, I think we can all agree that we need to engage with some sort of investing plan during the accumulation phase of our life, so that we can have a proper nest egg. And you can't think of the accumulation phase as being the opposite of the distribution phase. In the distribution phase, we're living off of money. And in the accumulation phase, we're putting money into the investments. The behavior mathematically may very well be flipped or reverse of the opposite season in many ways. One question that you all have had, especially back on the Dave Ramsey 8% stuff, is, does sequence of returns risk, does market volatility impact me, impact you in the accumulation phase positively or negatively? We know that sequence of returns risk is an obstacle that we need to overcome with our retirement distribution strategy. It's why different retirement distribution strategies are a hot topic. Sequence of returns risk is a big reason why it can be dangerous to go into retirement blindly without a distribution plan that we understand. But the accumulation phase is the opposite of the distribution phase. So if volatility, sequence of returns risk, is a detriment, an obstacle to overcome in retirement, is it something that can mathematically help us during the accumulation phase? Is it something that can widen our odds of reaching our retirement goals, just like a good bowling ball can increase your odds of getting a strike? And to dig into this topic, let's start where many of us do, as we're trying to figure out how much money we need to be saving in order to retire with dignity, and that's going to be with the retirement calculator. This is the Dave Ramsey retirement calculator. There are many tools like it. There are many more that are more robust, but this is one that's going to make for a quick and easy example. Let's just assume, for the time being, we have someone who's 20 years old who wants to retire at age 60. This individual currently doesn't have anything saved for retirement, but they're planning on saving $500 a month. And for our growth, let's put in something that already corrects for inflation. Dave would have you put in a number that doesn't correct for inflation. We're going to assume 7.5% to get things started. If we hit calculate, we see that in 40 years of investing, we contribute $240,000. Again, over 40 years, we end up with $1.5 million, just a little more than $1.5 million in today's money. That means 84% of what we have in our nest egg was growth from compound interest. This right here may very well be enough for someone to retire, depending on their distribution plan and depending on the lifestyle that they expect. But here's the problem with these sorts of calculators. They assume a smooth curve, that the market grows the exact same month after month, year after year. And I mean, that's fair enough to do a market projection, especially when we're talking about a lump sum that is plopped in at the beginning of the period to see how much it can grow to by the end. However, that may not be the best way to run a model like this, where you're contributing monthly, where you're making an effort to do what is known as dollar cost averaging by spreading your contributions out over a period of time. Because the market isn't a smooth curve. It goes up and down. So to investigate how that impacts us, I made a model. But before we get into that, let's talk about how or why volatility may impact our accumulation phase. So we just saw that you can have calculators with a smooth curve, but what if we put some wiggles in it? What if about 2/3 of the time the market is up compared to where the smooth curve would be, and the other third of the time it's down by an equal amount? Well, if you're putting in money evenly throughout each month, You're buying high more often than you are buying low. But if most of what we're buying is bought high and the minority is bought low, we may end up, once the whole thing is smoothed out, seeing a suppression of our overall growth, something that falls shy of what we were expecting from a smooth curve. Conversely, if we're in a season where the volatility has the market down below where the smooth line would be 2/3 of the time and above the line proportionally 1/3 of the time, well, we're buying low more often than we are buying high. We are purchasing a basis in our investments that's below what we saw in the retirement calculator a few minutes ago. If this is the case, then volatility is helping us boost our return by basically giving us a sale, giving us a deal more months than it's giving us a premium. There's also a problem of sequence. If you had a whole lot of low years early on, and half the time you were buying below the curved line, and then later in your accumulation phase, you were buying above the line, the latter half, well, the investments that you purchased at a premium were purchased later on and didn't have as much time to grow. Meanwhile, the ones that you bought on sale and had more room to grow in order to match that geometric average curve, well, those have a higher propensity to increase your overall nest egg. So not only does it matter how often the market is up versus down, but the order in which the ups and downs will impact, in theory, how your accumulation phase goes. But is it a big enough impact for us to worry about? So what I've done for starters to investigate the problem of volatility in the accumulation phase is take two hypothetical models of stock market mutual funds or ETFs. I've taken both of them and had them grow at the same rate or near the same rate as an S&P 500. I've taken that same $500 we had in the initial example and applied it to the investment every month for, in this example, 10 years. I've got another one for 40 years coming up, don't worry. The blue graph, if you can see the video, has a very nice, almost normal symmetric distribution about it. It's relatively narrow compared to its comparison. Meanwhile, there's a yellow graph that is much more skewed. It's got a hump that's lower on the final value, and it's got a tail that trickles out past the blue line. And when it trickles out past the blue graph, past the edge of the blue line, it's indicating that there is a statistical probability that you will accumulate over these 10 years more than you would investing with investment number 2, the yellow investment, versus investment number 1, the blue investment. The blue investment is less volatile than the S&P 500. I have the standard deviation for percentage change month to month set at around 3%. The yellow graph is twice as volatile, has twice the standard deviation as the blue fund. So yellow fund, more wiggles, more bumps, more roller coaster-like behavior. You can see blue is more predictable. Now, if we were to go to the Ramsey retirement calculator and to punch in the parameters for growth that I had for this, we would expect after 10 years to have $88,500. That's right about what we would be anticipating using a simple tool that doesn't get into market volatility. If we were to look at this through the lens of the 3% standard deviation month per month, the average, the middle of the blue graph, the average part is $87,900. So that's a little less than the smooth curve. It's suppressed because there's some volatility. And the median is even more suppressed. This indicates that there's a skew. If the average and the median were the same, we'd have more likely something that resembled a perfectly normal distribution. The median in this case is $86,700. But check this out. The yellow fund, the yellow graph, has an average of $85,650. Meanwhile, the median is $80,000. That's $6,000 less over 10 years than the blue graph. This means that by increasing volatility, we are suppressing the expected value that we can get out of investing in this fund. Strictly under the assumptions of the model that I have, this assumes that both funds had the same amount of growth, one was twice as volatile as the other, and that the Monte Carlo simulations that I ran, which were inflation corrected, so everything's in today's dollars, is an accurate representation of statistical probability. And if you were thinking that volatility was going to help win out on a longer time horizon for the accumulation phase, I've got some bad news for you. A smooth curve for the average growth that's punched into both of these funds, the yellow and the blue, would have yielded an expected $1,397,000, almost $1.4 million. For the blue fund, which is the less volatile, the first one, the average for 40 years of growth at $500 a month in my model is $1,328,000, and the median drops all the way down to $1,220,000, which means that the fund that is less volatile than the S&P 500 is suppressed and skewed because it has volatility. The yellow fund is worse off. It has an average of 1.1 million and a median of only $835,000. You can see that if you were to cut the graph in half and say there's a 50% chance of me accumulating more than this and a 50% chance of me accumulating less than this, that line that you're using to cut the graph in half is less than, in all accounts, for this particular part of the example, the smooth projection that we had from the Ramsey solution calculator. And if you can see the visual for this part of the podcast on YouTube or Rumble, I want to give you a different way of thinking about the graph that I'm using to illustrate this example. The area under the line, if you were to add it up for all of each fund, equals 100%. These are normalized. So the area under the line is equal to the odds that you will accumulate money that falls within that range on the x-axis. You can see that the area on the yellow graph, the more volatile fund, is massive to the left of the blue graph in its entirety. If you were to add up all of the area underneath the section that falls short of the blue curve, you'd find that it equals about 30%. That means if you pick the yellow fund that's more volatile, but has the same average growth as the blue fund, again, both have the same growth, you have a 30% chance of accumulating less than any amount that's possible going with the blue. Well, this makes volatility look like it's a real bad deal that narrows our target. It makes it harder to reach our goals for retirement. But wait, you might say, there's that little bit of tail on the yellow graph that goes past everything in the blue. You see, the blue is more narrow. We know that we are more likely to fall within a tighter range if we invest in the less volatile fund. But the yellow has a higher propensity to grow. Its largest amount on the graph exceeds $4.2 million. Meanwhile, the blue fund never gets above $3 million. So there's nearly a 30% chance that you come out behind if you go with the more volatile fund. But there's also a 6 to 7% chance that you come out well ahead of anything that the blue fund could do because of volatility. The bigger wiggles in the more volatile fund do enable a mathematical, statistical chance that you accumulate much more because of volatility alone, but it also introduces the risk of seriously suppressing your accumulation over time. Now, with that summary, you might think, well, I'm just going to go with the less volatile thing, but there was a very critical assumption that was made here in this particular example, and that is both funds had the exact same growth rate. If you go with something in reality that has a higher growth but higher volatility, maybe we get a different result. And for that reason, I took some historical data and put it into my Monte Carlo simulation spreadsheet. And before we get into these results that are modeled off of realistic historical data, I want to say that I took the outside 5% for each data set that came out of the simulation, the best 5% and the worst 5%, and I chopped them off because I don't think that they represent anything that's realistically, statistically appropriate to put into these graphs for you. I wanted to trim out the unrealistically depressing and the unrealistically optimistic chunks of the simulation. And I ran 10,000 data points, 10,000 simulations for each input, which means for each fund that we're getting ready to look at, the simulation results that are graphed equal 9,000 points. Okay, with that in mind, let's go through the different funds that I have here. There is a large spike that goes all the way up to 40% confidence for an all bond portfolio during the accumulation phase for a 10-year time horizon. That's what we're looking at right here. It's a 10-year time horizon. And it is centered right around $69,000 for the middle of its distribution. And compared to the other parts of the graph, it looks like a nice normal distribution. Seriously, this part of the graph is so narrow. I feel like if I'm investing in something that is so low on the volatility scale, I can be confident about where I'll fall. But you'll see that the bulk of the range encompassed by the blue graph for the bonds falls short of all the other portfolios, even if we were to cut them in half. In essence, we are trading off significant probability for out-earning the bonds for that confidence of outcome. Next, I want to talk about the green graph. It's produced by using the historical data from the S&P 500, and it's centered right around $85,000 to $88,000 for the outcome after 10 years for $500 a month. This is about $1,000 to $4,000 shy of what we would expect on a smooth graph, and it spans a much larger range. It's got a tiny little bit of the graph that lags behind the bonds. There's actually a 6.5% chance that you don't accumulate as much as you would confidently investing in all bonds. However, the results show that there is a 60% chance investing in the S&P 500 that you outperform what you can confidently get for an all bond portfolio. And that is the edge, the top end of what we statistically found could be accumulated with the bonds. This range goes all the way from right here near $85,000 all the way to right here at $150,000 in 10 years. But what if I traditionally rebalance so I always have 70% stocks in the S&P 500 and 30% bonds? Well, if I take the historical data from those inputs and I model it out, we get something that shrinks up. We find the yellow graph, this little stubby bit that represents the odds that you underperform an all bond portfolio, now equals roughly 4%. Meanwhile, an all S&P 500 strategy was 6%, the green graph here. So we trimmed out a little bit. We trimmed out about a third of the risk that we underperform what we could otherwise do confidently. And the tail of the green graph only extends past the 70-30 portfolio with a 6% chance that you outperform it. So you're not really giving out too much, but you are really trimming up the maximum possible given what I saw in the simulation. You go from $150,000 with the all S&P to $130,000 is the max end of what is statistically likely in the model for the accumulation with a 70-30 portfolio. And that brings us to the widest graph here by a long shot, the one that caps out with a maximum potential accumulation in 10 years of $180,000, and that is going to be my 401k. It is significantly more volatile than everything else that's here. In fact, the odds of underperforming an all bond portfolio are double that of an all S&P 500 simulation. There is now over a 12% chance that we fall in this area, and that tail drags all the way down to just shy of $45,000 for the accumulation. That means that volatility can significantly increase your risk of underperforming what you could have otherwise done. Even if it is only 12%, there's risk here, but there's still a nearly 60% chance under the red curve that is entirely past the all bond portfolio. There's a 15% chance that we make it past the 70-30 portfolio, and though it may still be small, there's still a 6.7% chance that we outperform an S&P 500 and get past the $150,000 accumulation point for 10 years. For those of you who are extra visual and go to find the video on YouTube or Rumble, this is the same graph just trimmed up so that the y-axis range is cutting off the all bond graph. This way you can get a more granular look at what we were just going over. And I think you're going to be pretty grateful that we can trim up the y-axis to get a little bit more detail, because otherwise the graph that I have with the results from the 40-year simulation would be really hard to read. You see here for the 40-year time horizon during the accumulation period, bonds are still much more predictable. Because they don't have near as much volatility, they can be predicted with much more confidence. That is very clear looking at how wide the rest of these graphs are. And again, we're assuming $500 a month for 40 years for the bonds. That gets you an accumulation that centers right around $425,000 in today's money. But I'm more interested in the more volatile options here over 40 years as they look much more appealing. So let's go ahead and trim this up. That is much better. That's easier to read. We can see that if we go with a 100% stock portfolio, we've got the green graph again, and the vast majority of it exceeds the edge of the bond portfolio. You can see that an accumulation portfolio with a stock bond mix, again going with 70% bonds, 30% stocks, has a higher confidence that you fall right here in the average or the center of the graph. And it gains this confidence that is elevated above the green graph by trimming up the tail, this little chunk of the green graph, the S&P 500 graph that goes past the edge of the yellow, gives you, 7.7% chance of out accumulating a more diversified effort. Check out how far the tail on the 401k stretches past the edge of the S&P 500 graph. This red tail stretches all the way to nearly $6.4 million in a 40-year accumulation period. Meanwhile, the S&P 500 modeled data stopped before 4 million, but there's only a 5.4% chance with my 401k that you end up out accumulating the S&P 500 modeled data due to the increased volatility. And you can see over here, there's a tiny, tiny risk that you end up under accumulating an all bond portfolio, which means that there's a higher propensity for reward and a trade-off for increased risk that exists even if it's minute. Now, in the simplified hypothetical example where we were comparing two funds that had the same average growth but different volatility, we had a clear idea that something that was less volatile was probably going to be more prudent than something that had more of a roller coaster going with it. However, as we go up in volatility here, we do see that the center of the statistical graph, not just the smooth curve, but the center of the statistical graph here moves further and further for higher accumulation. Again, the centering is where you chop it in half and say, I have a 50% chance of out earning this number and a 50% chance of under earning this number. For the bonds, that was centered right around, let's say, $422,000. For the 70% stock, 30% bonds, that was centered just shy of $1 million at $979,000. For the all stock portfolio, the S&P 500, that was a $1.1 million median centering of the graph. And for this big red one, my 401k data, that model centered at $1.2 million, meaning that there is a reward in the hypothetical models that we have here for taking on more risk, less certainty as volatility increases. Now, that's not necessarily to say that it's strictly due to the volatility. There are other factors here. The increase in growth is something that cannot be ignored. But here's the thing I want to highlight. Average growth is not always going to be an indicator of what is best for you. Sometimes we need something that has more confidence. Sometimes we need something that doesn't have the wild uncertainty that high volatility comes with. And I've always said that volatility is not always equal to risk. I think this both illustrates that while also showing why volatility is often associated directly as being synonymous with risk. Truly, I think this example highlights why it's important to have a risk correction factor that is tied to volatility so that you can compare growths apples to apples. So you can compare the statistically likely growth that you're going to have across the board. Average growth cannot be compared apples to apples if the volatility or the beta are different between the two of them, because something that's more volatile may have a suppression to it that can't be reflected in the average growth numbers. The average growth might look awesome, but you're not going to get the kind of granularity or understanding you do looking at a hypothetical educational example like this. Speaking of, this is not investment advice here. This is for educational purposes only. Please refer to the disclaimer in the description. The thing that I'm taking away from this is that I'm going to be paying more attention with my funds when I go through and balance them here in 2025. I reevaluate where my retirement funds are every 5 years. I'm going to be taking a special look at the risk correction calculations around volatility. So I know that I'm not overexposing myself to uncertainty that makes it too likely that I'm going to underperform my goals. I'm going to be able to take the lessons that I have here and have a better understanding of the range that I need to hit to make my retirement goals a reality and structure a portfolio that gives me as good a growth as I can afford to have, but not with volatility that results in undue risk. And I'm not going to be blindsided by the trade-off of having a very, very high possibility of return or accumulation if the trade-offs, the downsides, the cons outweigh the very, very unlikely benefit. With that, I want to know, what did you think of this example? Is there something that I can do to further explore volatility during the accumulation phase that you think would be interesting? Do you think that a Monte Carlo simulation approach, like what I did here, is a fair representation, or am I missing a significant portion of how volatility actually engages with the accumulation phase? I know that there are limitations to Monte Carlo simulations. I feel confident that they can illustrate in an educational capacity the reason why volatility matters, and the reason why we got to think about it, and the reason why we can't trust the smooth outcome on the graph without some sort of correction for volatility. But I also want to be providing something that interests you and something that you feel like you can learn from with confidence. And with that, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.